What's up, YouTube? I'm back. So we do have a lot to discuss today. Basically, what I want to talk about, the topics is index funds, okay? So I want to talk about index funds, mutual funds, and basically ETFs as well, exchange traded funds, just to kind of give some more clarity and just to kind of see what they are exactly. And with that, I want to basically tell you guys why I feel like investors should invest into the index funds and mutual funds and ETFs as well. Just because some people don't really like to look at balance sheets and kind of pick particular stocks they want to invest into. I'm gonna just give you guys my opinion on why I believe people should, and just exactly what they are and how they work for people and how they can be a benefit. So basically, I'm gonna start with basically what an S&P 500 is. So S&P 500 is just a weighted average of 500 stocks that we have in the U.S. So it was created to basically track how the stock market was doing. So they created that, and I guess investors or important people saw that maybe it'll be good for them to make a thing such as an index fund, right? Because with the S&P 500, you can't buy shares, you can't trade it. It's just to track the stock market, so you can't trade it at all. You can't do anything like that. So with the index fund, they came up with the idea of how to basically make a accumulation of whatever is in that S&P 500 in an index fund. But with the index funds, you can actually buy and trade stocks basically. And it tracks the S&P 500 as well. So it tracks basically the stock market or whatever the index fund is tracking, because you can have it track different sectors as well. So it does kind of get confusing between what an index fund is, what a mutual fund is, and what an ETF is. So I'm about to try to break that down for you guys. So we just discussed the origin basically, which is from the S&P 500, and how they basically created the index funds. So I'm gonna go into basically what a mutual fund is. Okay, so with the mutual fund, you have you can classify it as an index fund as well, because it is supposed to track different stocks in the whole portfolio. So it's a portfolio of different stocks, and when you have that portfolio of different stocks, it basically spreads out your money into different things, right? So you're not investing into one stock or one company like that. Like you're more diversified, and that's what everybody wants to be, just to kind of mitigate risk and to kind of stop, just like you from losing an excess amount of money. Because if you're invested into one or two companies and that company does bad, then you're losing a lot more. But if you're investing into an index fund or a mutual fund, which has 500 companies, 500 stocks, or that has the total stock market, or that has specific sectors of the stock market, you're allocating your money into different places basically, and it's giving you a better chance, I would say. So with the mutual fund, it's a little different. I classify it as index fund as well, because it all stem from that. I mean, they all have basically stocks in them, a portfolio of different stocks, and they all can track different sectors as well. And you can invest into them. The only difference I would say that a mutual fund has is that a mutual fund is not traded as a stock like index funds are. So they're not traded like during the stock. I mean, you can buy them, but they're not like, their price doesn't fluctuate during the stock market. Okay, so during that time frame you have in the stock market, ETFs, their price can go up and down, right? Index funds price can go up and down, just like a regular stock. They're traded just like a regular stock. People trade them just like a regular stock. Mutual funds, their price stays the same pretty much. The prices are only altered or changed, or that you see the full, like what happened in that time is when the market closes, and that's when the manager of that mutual fund basically shows you what the price is after the market is closed. So if the price is not going to fluctuate like a ETF or a index fund, right? And another thing with mutual funds is that they are actively managed as well. So that means you have somebody that's looking over it and seeing what's the best mutual fund in that sector, what's the best stocks they can have in, like for that sector in that mutual fund, because you know you're playing with a lot of people's money. So it is actively managed. You know, I'm interested in one myself. I'm gonna let you guys know at the end of the video if you want to stick around. I'm gonna give you guys a mutual fund that I'm looking at too, and an index fund slash ETF, because I believe index funds and ETF are pretty much, they're all pretty much the same thing. Their gross expense ratio is a little more pricier than the ETF or index fund. The gross expense ratio to me for a mutual fund that I'm looking at, it's 0.7, which isn't bad at all. It's just basically what you would have to pay, or how much you like, basically how much they would take out, I guess, per 1,000. How much you put in per $1,000. So with the, you know, so they take out 0.7% per $1,000 you have. You can do the math. I'm not going to do it. So they do that. So basically, that's the gross expense ratio you should be aware about, which isn't even too bad, because if you're making, if let's say you choose a good mutual fund and you see their average, or you see like you see what their average is looking like, yeah, and you see that if you would have invested 10,000 in 2010, right, just once, and then you see what the price is now, it's 40,000 or 50,000, and that 0.7% for per thousand is nothing. I did the math before. It's like what, 200 and something dollars. So it's nothing. You know what I'm saying, to the amount that you're gonna make. You know. So always look at that as well. Some of them do run like to like 1.0%. So, you know, just be careful what you choose. An ETF is basically there. I classify mutual fund and ETF as an index fund. Okay. I'll classify them all the same, basically, in terms of their underlying, because they all can track different sectors, and they all can track different sectors, and they all have a portfolio of different stocks, and that you can put your money into and allocate so you can have a better positioning. Okay. So they're all the same thing. Don't be confused about what other people are saying. They're in the same category, but they all have specifications, like I told you with the mutual fund. So an ETF, exchange traded fund, basically is an index fund. It's supposed to track the S&P 500. You can have ones that track the S&P 500, right? I believe the VU is a Vanguard. It's V00. I forgot the name. The ticker is V00. If you want to search it up, the VU is a good one. I like it, but it just it tracks S&P 500. So whatever the S&P 500 is looking like, my bad. I'm over here coughing. It's not what you think. So like I was saying, whatever the S&P 500 is doing, whether it's going up or down, it tracks that. You know what I'm saying? So whatever, like all those stocks that's in that portfolio tracks it, I believe, because I think the VU it's also it's 500 stocks or whatever it has in it, bond stock, whatever. So it tracks that. So you gotta, be prepared to lose money when the industry is doing really bad. Like now, you gotta be prepared. Like, oh, last year I was up 40,000. This year I'm down 20,000. Yeah, obviously, your ETF slash index fund is tracking the entire market. You know what I'm saying? So when it's tracking the entire market, or whatever it's in that market, if it's tracking the S&P 500, and the S&P 500 is down 30%, what do you think your index fund is going to be, ETF is going to be down to? The same thing. So you got to be prepared for that. The VU is nice. When I looked at it before, if you put 10,000 in now, it'll go up to like 38. Now it's down to 23, which makes perfect sense, because you right now the stock market is crashing. So with ETF, well, just like a mutual fund, you can track different sectors as well. I've seen an ETF that can track high dividends, which we'll get into what a dividend is, high dividend yield, and low volatility. So basically, they're giving out dividends, and the stock that's in that portfolio, the stock that's in that ETF, the stocks are in the ETF portfolio are presumably seen to have low volatility but give out consistent dividends or have high dividends. So you can choose an ETF that's in that category for that. You know what I'm saying? Which is cool, which is nice. So you'll know that, oh, whatever I'm investing into has low volatility, and high dividend yield. So it's giving you a decent amount of money for owning a share. You know what I'm saying? So there's different types of ETF like that too. But the only thing is, a ETF is not usually actively managed. You know, they just track whatever they're tracking, have the stocks mapped out, whatever stock they want to map out for that sector, have it, and just leave it like that. You know what I'm saying? Some might be, but not usually actively managed. And that's where a mutual fund comes in. And that's why I believe their gross expense ratio is higher, because of the way they're managed. In my opinion, it's a little more tenuous than an ETF, which I don't believe is as combed through. With the ETF, you can also, like I said, with the ETF, you can also actively trade it. You see the price fluctuates up and down in the stock market. And that's pretty much what it is, guys. It's not that difficult to understand. And I'm gonna give you guys a reason why I believe people should invest into it. To me, I believe the best thing for me will be to invest into a mutual fund, find a good mutual fund with zero commission. Zero commission. You can see that, like, I use Fidelity. When you go scroll down on Fidelity and you see their portfolio holdings, you can actually see what an ETF and a mutual fund, you can see what they're holding in their portfolio, like the stocks they're holding in their portfolio. You can see that. You just got to do some research on that, or whatever brokerage you have, you can see it. So I would say I would invest into a mutual fund just because it's more actively managed. The one I'm looking at right now, even though the stock market is doing bad, if I would invest $10,000 10 years ago, I would have $40,000 now. Think about that. You know what I'm saying? Just really think about it like this. Sit down and think about it like, whoa, wow. You know what I'm saying? So imagine if I put 20,000, 2010, what would that be now? $80,000. You know what I'm saying? In that mutual fund. Mutual funds, they to me, they're better return on your investment, to be honest. They do have a higher gross expense ratio, but it's not that bad. You know what I'm saying? You're not paying any commission. You don't have any, the one I'm looking at, you don't have any minimum to invest. You don't have to have 2,500 to invest. You don't, none of that. Same thing with the ETF as well. And the index funds, you don't have, there's usually none. Some of them do have, some do have a minimum that you have to invest, and they'll tell you before you do it. You'll be able to see that. You're not going to let you invest if you don't have that. You know what I'm saying? So, but most of them are, they're really made for, the average Joe, you know what I'm saying? Like me, like you guys, whoever. So I would say look into some good mutual funds. Don't get confused with what the index fund is and what an ETF is. The way you can tell, like I said, would definitely be looking at like the looking at the gross expense ratio. That's how I could tell. Or you could just call your brokerage up and just ask them. They don't really make it easy to tell, really. You could just ask them. I do believe in Fidelity. When I try to trade, it'll tell me what I'm trading. So you can see it's a mutual fund, and you can see that it's either an index or ETF. In Fidelity, you can only fractionally trade index funds and ETFs. Okay, so you can't fractionally trade mutual funds, right? So you got to buy the entire fund at once, right? Which isn't too bad. So people use it because they decide, they don't have time, like I said before, to just kind of research stocks. They rather just have their money sit and just grow a good amount and just go on their way, which is actually, it's good too. You don't have to be all thinking like, oh, what am I, just worrying yourself when you can invest into something that's, guaranteed to go up anyway. You know what I'm saying? That $10,000 you put, at least is going to go up. It's not going to go down it's going to go down sometimes, but it's on average, it's going to do better than, what you think. And also, your money will grow, you know what I'm saying? So even now, like, it's dropped, but people, like, their whatever they put into their index funds did grow, you know what I'm saying? And they saw it themselves grow. So with the index fund, I would put that in, I would basically purchase that within my Roth IRA. We already discussed what the Roth IRA is. I'm going to have a video coming out explaining it in better detail for you guys. So I would invest into that in my Roth IRA. And that is just for a long-term investment. I wouldn't trade ETF, like, like you're day trading it or anything. You can do puts. You can do that, or you can do options trading on ETFs. You can do that, but I wouldn't day trade them because it's just no point. I mean, it's for long term investment. So if you're looking into an ETF or a mutual fund or index fund, they're all for long term investment. Don't think that you're flipping your money like that. Nah, it's it's for the long term. So I would advise everybody, to get into it, and look at what they are and try to invest into them consistently. Me, I'm doing both. I'm investing into a mutual fund, and I'm also looking at stocks that I want to choose myself because I see the way the prices are. They're lower now, and I want to choose them to invest into for myself. You know what I'm saying? And because, that's you're not going to have that flexibility with the index fund to, to choose. So, or that's pretty much why I do what I'm doing as well. Hey guys, like I said, I'm gonna show you basically, or I'm gonna tell you the three index funds, mutual fund, and also a ETF that I suggest, and I'm also interested in myself. Just giving you guys some three suggestions. So as we can see, we're on my fidelity. This is not the stocks I'm invested to. This is just my watch list that I'm interested in. So we're gonna go by looking at. Let's start with a index fund. So the VOO. It's classified, as you can see, VOO, Vanguard 500 Index Fund. So it basically it basically copies what's on the S&P 500. The 52-week low was 255 cents, which isn't bad, and that was April. That was March 23rd, 2020, and the high was in February 19th, which is 311.59, and now it's at 255. So it's actually doing rather well, and you'll be able to see why real soon as well. See, it is an ETF, like I said, but it's also a index fund because it tracks the S&P 500 index fund. That is the benchmark index that it's tracking. But it is also an ETF, so don't get confused when people are saying index funds and ETF. They really mean the same thing. So you can see the top 10 holdings out of the 504 apparently that is holding. So you can see it's Microsoft, Apple, Amazon, Facebook, Johnson & Johnson, Alphabet again, Berkshire Hathaway, Procter & Gamble, and Visa. That's Alphabet is Google, Class A and B shares. And that's what it's dividing your money. So when you pay that 255, it's allocating your money between these different companies, between all 504 of them. And you can see that it holds some heavy hitters like Microsoft. All those are really good companies. As you can see, the top 10, that's really the top 10 in the U.S. stock market alone, really. So yeah, it does rather well. But right now it's not doing as hot because, the stock market did crash and drop off tremendously. So of course you would know that the VOO would also drop off as well. They're related. Okay. Yeah, so you can actually look at the performance down here. I'm not going to click that because we're running out of time, but you can look at the performance and risk and all that information, portfolio composition. You can look at all that down here. So I'm going to go back up and I'm going to show you guys. Let's see if we can look at a ETF now, right? So it's already here, SPHD, which is a it's basically S&P 500 high dividend, low volatility ETF. So basically, it tracks high dividend yielding stocks and that have low volatility. So right now it's at $31.11. The lowest was 25, highest was 44, which isn't bad in terms of where it's at now. It's actually climbing up rather well, I would say. And they didn't even take that crazy of a hit, really, in my opinion. I mean, almost half, but it wasn't the highest price to begin with, but it didn't really take a crazy hit to me. So basically, it tracks the S&P 500, but out of that, it takes basically what stocks that have high dividends and low volatility. So out of that 500, it takes stocks that have that characteristics. So this is has this stock this what am I trying to say? This ETF has its own criteria of what it's tracking, has its own part. So as you can see, all the ones, the top 10 that it has here are basically the top 10 that has, high dividend yield, the ones that give out really good dividends, and also what has low volatility. So it's not gonna go crazy in the stock market. It's not gonna drop as hard as other stocks. And this is kind of, I'm not gonna lie, it is looking really nice. I like the AT&T. I have two AT&T stocks. They paid me $1 recently, and I only have two of them. So you do the math on that, on how good their dividends is. And basically when the stock market crashed, they didn't really go that much in price. They didn't really lose that much, as other stocks did. So this is a nice one. I always recommend it. I would recommend it as well. And you can also see the same thing, the performance down here. So it's really cool. I like it, definitely. Yep, definitely. So let's get out of here. And I'm going to show you a mutual fund that I am extremely interested in. So we can look at this right here, the SPHX. So this is a mutual fund, and it's not going to fluctuate as much in terms of pricing like all the others are. So, and it is a health category. It's a healthcare portfolio, and 5 out of 5 stars. Great. You can see the performance it has. So on average, it does rather well. Of course, it's like this year, it's obviously doing not as good, but we did have a crazy stock market crash that's like different. Nobody's ever seen something like this. But on average, you see it does first year 5%, 3 years 11.5%. 5 years, almost 6%, 10 years, almost 16%, life of the fund, 15% increase. You kind of, if you have if you do like a high interest savings account, what's the highest is going to be in America? Like what, 1.0%, which is nothing compared to this. So to me, if you're investing your money into a high interest savings account, you're doing it a little backwards, man. So try look for a good mutual fund like this one, or even an ETF or index fund, and you see that your money will increase. So you can look at the holdings that it has. These are all the healthcare holdings that it does have. It is a growth fund as well. Definitely, this is probably my favorite mutual fund. And you can see all the other stuff down here that you can research. So yeah, that is everything for you guys. I hope you guys, look into it, see what I'm saying as well, do your own research on it. There's a lot of index funds, a lot of mutual funds, a lot of everything, man. You just go out there and do your own research and you'll be fine. Thank you guys for watching. Just like, subscribe, everything, turn on the notifications for me. So every time I make a video, you be able to hear it. And please do it for the YouTube algorithm. Thank you.